On the morning of March 30th, 2026, three different people stared down at the exact same red screen. Lloyd was sitting in a grocery store parking lot, his phone in one hand and a cold brew in the cup holder. He refreshed his brokerage app for the 11th time before he even made it inside. At exactly 10:22 in the morning, he sold absolutely everything. Nadia was at work. Her phone buzzed twice with breaking news alerts, and she simply swiped them away. 7 months earlier, she had written one sentence on an index card and taped it inside her desk drawer, and that card told her to ignore the screen. Gwen has $300 million. Her family office called her that same morning. The entire conversation lasted 4 minutes, and absolutely nobody sold a single share. This chart shows the market's trajectory over that period. By the middle of April, the market had recovered every point it lost. 2 of those 3 people came out ahead, and the smallest account was in that winning group. None of them saw this crash coming. The most expensive myth in personal finance is your quiet suspicion that rich people get a secret warning you don't. They don't. Nobody does. If you are doing the math on how many months of your contributions just evaporated, you are not being stupid. You are having a correct threat response. You're running on hardware built to dodge physical predators, but you're applying it to a digital app that updates your net worth every 11 seconds. The entire setup is perfectly engineered to induce a panic sell. Every year, UBS surveys single-family offices, the private investment operations of ultra-wealthy families. The families in their recent report averaged $2.7 billion in net worth. If anyone gets early research, it's them. This chart illustrates exactly what they plan to do with all that exclusive insight. While the news urged everyone to move to cash, 59% of these billion-dollar portfolios ran the exact same risk as the year before. They changed absolutely nothing. Missing the 10 worst days of the market sounds incredibly safe, but the median gap between one of the 10 worst days and one of the 10 best days is exactly 7 days. The market's greatest single-day rallies are welded directly to the panics. Michael Burry made his investors around $700 million shorting subprime mortgages. He was perfectly right in 2008. Then he spent the next decade making bearish calls that didn't land, missing out on massive market gains, and eventually shutting his fund down entirely. John Paulson's funds made about $15 billion in 2007. 4 years later, his flagship fund was down 96%. By 2020, he had handed back all outside money. Both men nailed the greatest market calls in modern financial history, and neither could do it twice. Accurately forecasting a crash requires you to be right on the exit and right on the re-entry. Buying protection by moving to cash guarantees you pay for that safety every single year the market isn't crashing, bleeding you dry during the recovery. This chart shows how different wealth brackets allocate their money. The top 1% of American households hold roughly 53% of all the private business equity in this country. For the median household, the largest asset is the place they sleep in. Gwen's portfolio is filled with private companies. These stakes have no ticker, no price quoted every 11 seconds, and absolutely no way to sell them in a panic from a grocery store parking lot at 10 in the morning. You will hear that private equity holds up better in crashes. The truth is that private assets get valued by slow appraisals, not by real-time auctions. Nobody marks a regional plumbing company to market every 90 seconds. It carries the exact same risk, but the volatility is quietly removed from the chart. During that 4-minute phone call, nobody was asking Gwen for her opinion on the economy. Her advisors were simply executing instructions from a legally binding document she had drafted in January, months before the chaos started. Gwen isn't mathematically smarter than Lloyd. Her assets are protected by paperwork. She is shielded from her own worst instincts by the sheer bureaucratic friction of her portfolio, while you are staring down a sell button that is always 11 inches from your face. You can artificially build Gwen's emotional constraints into your own accounts using completely free mechanical tools provided by any standard brokerage. Step 1 is setting up automated rebalancing bands. You decide in advance that if your stocks drift more than 5% from your target, the system automatically sells what is up and buys what is down. No meetings, no opinions, no human intervention. Step 2, tax loss harvesting. You sell losing positions, bank the loss on paper, and carry it forward to offset taxes. To claim it, you follow the wash sale rule. You cannot repurchase the identical security for 30 days. Instead, you buy a cousin asset. Step 3 is converting your traditional retirement funds. Moving money to a Roth account costs significantly less when prices are down. Your tax bill gets calculated on the smaller, depressed number, and the entire market recovery lands at an account where it will never be taxed again. Lloyd did the exact opposite. By panic selling everything in a taxable account, he realized unwanted capital gains and locked in a massive loss he can't fully use. He managed to lose twice in a single transaction. Nadia built her own version of Gwen's January document for the cost of an index card. It said in her own handwriting, "If it drops more than 20%, buy and do not check again until June." The market will not reward you for seeing a crash coming. It rewards you for having already written down exactly what you will do before it arrives. You have to fire yourself from the job of reacting, so the frightened version of you is nowhere near a phone on the worst day of the year.